on financial stability. The Indian financial sector has been stable and resilient as reflected in sustained growth in bank credit, low levels of non-performing assets, and adequate capital and liquidity buffers. Macro stress tests for credit risk reveal that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress scenarios. There is, however, no room for complacency because it is during tranquil and good times that vulnerabilities may creep in. Hence, buffers are best built up during these periods. A stable financial system is a prerequisite for price stability and sustained growth. This is a shared responsibility in which regulated entities like banks, NBFCs, and others are important stakeholders. On its part, the Reserve Bank remains steadfast in its commitment to safeguard the financial system from the emerging and potential challenges. We expect the same from the regulated entities also. As regards the external sector, India's current account deficit was contained at 2% of GDP in 2022-23 as compared with 1.2% in 2021-22. Merchandise trade deficit has narrowed in the first quarter of the current financial year, that is 23-24, with contraction in imports exceeding contraction in exports. Services exports and remittances are, however, expected to provide cushion to the current account deficit. We therefore expect the current account deficit to remain eminently manageable during the current financial year also. On the financing side, foreign portfolio investment, that is FPI flows, have remained buoyant in 2023-24, that is in the current year so far. Net FPI inflows have been US $20.1 billion up to August 8, which is the highest since 2014-15. In the corresponding period of the previous year, there were net outflows of $12.6 billion US dollars. The inflows under external commercial borrowings also witnessed a turnaround with net inflows of $6 billion US dollars during April-June this year, as against net outflows of $2.9 billion US dollars a year ago. Net foreign direct investment, that is net FDI flows to India, on the other hand, fell to $5.5 billion during April-May 2023 from $10.6 billion a year ago, reflecting a global slowdown in FDI inflows or in FDI flows. Latest available data suggest that India's external debt to GDP ratio improved to 18.9% at the end of March 23 from 20% at the end of March 2022. The Indian rupee has remained stable since January 2023. Foreign exchange reserves have crossed the mark of US $600 billion. The umbrella has gathered strength, and I am not saying